Hi guys, today I would like to dive in another financial instrument, the ETF or Exchange Traded Fund. I will break down the ins and outs of the ETF and I will explain why they've become such a popular investment choice. But first, thank you for stopping by. Here we talk about minimalism, fitness, finance and things of that nature. So if you're new to the channel, please like and subscribe and let's get started. Disclaimer, I am not a financial advisor and this video does not contain any financial advice. So, starting with the basics, what is exactly an ETF? Well, an ETF or Exchange Traded Fund is a type of investment fund that is traded or exchanged on a stock market. They trade exactly like stocks, but when you buy an ETF, you're buying a pool of assets that can include stocks, commodities, cash, derivatives, and so on. How do ETFs work? ETFs are designed to track the performances of an underlying asset. Usually these are indexes such as the S&P 500 or the Nasdaq. These two are the two most important indexes from the American market. The S&P 500 includes the 500 biggest companies in US, while the Nasdaq includes more than 3,000 companies with an overweight of technology companies. So buying an ETF on these indexes will allow you to be exposed to a variety of stock instead of putting all your eggs in one basket. That is why ETFs are a simple way to be invested and stay diversified. Instead of picking single stocks, that is something that is probably not easy to recommend to a non-professional. For example, the SPY tracks the performances of the S&P 500, while the QQQ tracks the performances of the Nasdaq 100. Even Warren Buffett suggests to put 90% of his wealth in an ETF after his death. Isn't that true, Mr. Buffett?
Buy an S&P 500 low-cost index fund.
That is cool, Mr. Buffett, thank you. But remember, this is not financial advice. So let's discuss the three main benefits of investing in ETFs. The first one is diversification. Buying an ETF will expose you to a variety of companies and will decrease the risk of a singular poor performing stock. The second one is liquidity, as ETFs are exchanged and traded on stock exchanges exactly like stocks do, so they usually do not suffer of the low liquidity of some uncommon stocks. The third one is transparency. Since these funds are exchanged and traded, their holdings are disclosed daily, providing some transparency on what is happening into the fund. Let's talk about the cost. Differently from stocks, ETFs have also a cost besides their price. That is usually a small fee that is paid through the years over the price of the assets. This is due to the fact that these instruments are created internally into investment houses such as Vanguard, iShares or Invesco. In broad terms, the more an ETF would be popular, the smaller would be the fee. And obviously, a higher fee can weigh down on your yearly return. For example, a very popular ETF such as the SPY has an expense ratio of 0.09%, while a more exotic ETF such as the UPRO has an expense ratio of 0.91%. That is 10 times higher. Overall, the cost might be a big factor in very exotic ETFs, while it might not be such a big deal in more popular choices. What types of ETFs are out there? There is a wide range of ETFs available based on the investor preferences. Equity ETFs that offer exposure to indexes or region, or even to dividend stocks. Examples are the QQQ or the SPY that we already talked about, or the VYM for dividends. Bond ETF that offer exposure to a wide range of bonds, catering to different risk appetites. Some example can be the AGG. Commodity ETFs that tracks down the price of a raw material or precious metals, such as the AAAU that tracks the physical gold. Sector ETF that tracks specific industries. Examples can be the XLK for technology, XLB for healthcare, or XLP for consumer staples. Besides more traditional ETFs, using derivative instruments, more exotic and particular ETFs have been created. And this can be a very interesting tool to add to your tool chest based on your risk preferences and on the market conditions. Here are some examples. Leverage ETFs that are ETFs that use derivative instruments to track down with a lever the return of a specific asset, such as the UPRO that we already talked about, that tracks down for 3 times the return of the SPY. So for an increase of 1% in the SPY, the UPRO will experience an increase of 3%. But on the other hand, also for a decrease of 1%, it will experience a decrease of 3%. Other examples are the TQQQ that tracks the QQQ with a lever for 3. Short ETFs that are betting against a specific underlying assets. An example could be the SQQQ that is short against the QQQ, so against the Nasdaq. This can increase in value if the underlying asset goes down. Covered call ETFs that are ETFs that use a specific option strategy called covered call to produce monthly income. An example of this is the QYLD that does this strategy on the Nasdaq, so on the QQQ. Strategic ETFs that are peculiar strategies englobed into a single ETF, such as SWAN. This in particular is very interesting because it holds 80% of treasury bonds. The remaining 20% is composed by LEAPS options that are leveraged position on the SPY. These allow you to take part of the market through its leveraged position, but also to have a safety in case of market crash, thanks to the bonds. And in theory, this should hedge you from black swan events. So, as you can imagine from these examples, the range of possible strategies that you can find on ETFs is pretty much limited only by the imagination of the fund managers. So you can pretty much find any kind of strategy based on the market condition and on your risk tolerance. Now that you know what an ETF is and how it works, how do you invest in ETFs? It's simple, it's exactly like investing in stocks. Firstly, you need to research the product and you have to understand what you're getting into. Secondly, you have to choose a brokerage and open an account. A good option for Europeans can be Interactive Brokers or the Giro. Then you just have to place an order to purchase the desired ETFs. And finally, you have to monitor your position from time to time, manage and rebalance when needed. Like stocks, ETFs carry with them some risk. Let's talk about the risk then. The first and most important is the market risk, because your investment value can still decrease based on the market conditions. For example, if a lot of people sell the stocks that are in your index will go down as a consequence. Then there might be some tracking difference between the ETF and the index. In some cases, the ETF cannot track perfectly the underlying asset. This can be due to the index composition or due to fees. Finally, liquidity. While the majority of ETF is very liquid, there can be some very peculiar ETFs that are not liquid at all, and in this case you cannot sell your position without a significant discount over the price. So there you have it, everything you need to know on the exchange traded funds. ETFs have disrupted the way people get exposure to the market and get diversified. So whether you are just starting out or you are seasoned investors, understanding how ETF work is a very important tool in your tool chest. I remain open to any question you might have in the comments. Thank you for watching, guys. I hope you liked the video, and if so, please put a like and subscribe and go check my other videos here. Bye!